Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
If you're like me and you spend a lot of time on online investing communities, there's a good chance you've heard that Munger quote more than once. He's referring to adjusted EBITDA, EBITDA meaning earnings before interest, taxes, depreciation, and amortization, and how it is a very shoddy and unreliable measure of earnings. Now, why is this important? Well, if you make an investment in a stock, you need to know how much money the company is making, or at any rate is going to make in the future. This is referred to as the company's profit. Now, there are many ways of measuring profit. The most common one, and what's most commonly referred to as earnings, is net income, which is revenue minus direct selling costs. That gets you to gross profit, minus operating costs, which gets you to operating income or earnings before interest and taxes, minus interest, which gets you to earnings before taxes, and finally minus tax, which gets you to net income. You can also get into things like other comprehensive income, in which case asset price changes also influence earnings, but basically it's net income. The most commonly used profit measure is revenue minus direct selling costs, minus operating costs, minus interest and taxes. Given that profit has such a clear definition under the generally accepted accounting principles, you might wonder why all this fuss about adjusted EBITDA. If profit is basically net income, then why should I even be concerned about some alternate earnings metric? Why should I even pay attention to anything other than net income in the first place? And this is where you can actually get yourself into a lot of trouble. Because in order to thoroughly analyze a stock, you do need to look at measures other than net income. Charlie Munger, for example, although he says that EBITDA is bullshit earnings, he's also been known to criticize GAAP accounting principles when it comes to net income because they include the impact of stock price fluctuations, which is not a factor that has anything to do with how much cash investors can get out of the business or how much dividends the company can pay to its investors. So there are many ways of measuring profit, and some of them, in some circumstances, can be better than net income is. Given this, why is adjusted EBITDA so uniquely lousy, and why should investors not be paying attention to it? To understand why adjusted EBITDA is so problematic, we need to know a little bit about GAAP accounting. GAAP stands for Generally Accepted Accounting Principles, and basically it refers to either US GAAP, which is the Generally Accepted Accounting Principles of the United States, or IFRS, which is the standard that prevails in most of the rest of the world. Now, there are slight differences between US GAAP and IFRS, but the point is that most countries and most places are bound by regulators to follow certain accounting principles. And as a result of that, in all the financial statements they report to the public, there will be GAAP revenue, GAAP net income, GAAP gross profit, GAAP operating income, GAAP cash from operations, and all these different profit metrics that you know, provided the audit has been done well, have been calculated in a standard way. For the most part, if you have some training in accounting, you know what a given GAAP figure for any company is. For example, under a company complying with US GAAP, you will know that net income means revenue minus direct selling cost, minus operating cost, minus depreciation and amortization, minus interest, minus taxes. That's all well and good. However, most jurisdictions allow companies to report adjusted earnings metrics alongside their GAAP metrics, and this is where it gets tricky. Provided that you have provided the GAAP metrics in the first place, you're also allowed to provide adjusted metrics, which are equivalent to the GAAP metrics that you've presented and compiled in accordance with the GAAP accounting principles. And in these, you have a lot of leeway. In some cases, these adjusted earnings metrics that companies present can get pretty questionable. For example, in the Groupon accounting scandal, the company Groupon used a metric called net segment operating income, in which it reported as a kind of profit a sum that included fees that were about to be sent out to merchants. Now, if you want to know how ridiculous that is, imagine that you're a company. You have a salesman who you're paying 50% of all revenue to sell a given product that you paid 20% of revenue for. Ultimately, you've got 50% going out to the door to the salesman, 20% you're spending money on the product, and 30% is your profit margin. Well, what Groupon was doing was reporting this without including, or subtracting rather, the fee to the salesman as part of its costs. Therefore, it was essentially claiming a percentage of revenue as profit when really it was a cost. Is adjusted EBITDA a totally crazy earnings metric like that one that Groupon used during its accounting scandal? Well, it does have a relatively easy to define meaning, which is earnings before interest, taxes, depreciation, and amortization. In other words, it's like operating income or EBIT minus a few extra things. However, the problem comes with the fact that this is a totally non-GAAP earnings metric. There is nothing really governing what can be reported in or excluded from adjusted EBITDA. So, in addition to excluding interest, taxes, depreciation, and amortization from adjusted EBITDA, companies have a lot of leeway to exclude other non-recurring or one-time, what they say is one-time, charges to their net income that they would not like investors to see. As a result, it's a very easily manipulated metric, and it's extremely optimistic to begin with. Because EBITDA, even if you're not playing any games with it and excluding extra things on top of what's excluded from it in the beginning, you are looking at earnings minus interest, taxes, depreciation, which is the reduction in value of your assets as they wear over time, and amortization, which is depreciation for intangible assets. That is a lot of real economic costs that you're excluding from your earnings metric when you use an earnings metric like adjusted EBITDA. And because it's non-GAAP, you can exclude even more from it than that. This is one of the reasons why, when referring to net segment operating income at the Groupon company, one accountant said, essentially, this is revenue or earnings before everything, meaning that at this company, so much was being excluded from its profit calculations that they were basically just claiming their revenue as profit. Note that none of this means that non-GAAP earnings metrics are completely unreliable, or BS, as Charlie Munger would put it. Many of the most respected earnings metrics that people use in their investment calculations are in fact non-GAAP. For example, free cash flow is a totally non-GAAP cash flow metric that many people think is ultimately the best measure of profitability for investors to look at. So it's not as simple as GAAP good, non-GAAP bad. It's just that EBITDA happens to be a non-GAAP earnings metric that is really, really, really questionable. So what's the big takeaway here? It's that in investing, it always pays to take things with a grain of salt. Sure, companies are held to certain accounting standards and have to be audited, and most of the time you can count on the GAAP figures in income statements to be at least pretty close to the truth. But they're also allowed to present a lot of other earnings figures alongside those that can be, well, more or less made up. Earnings before everything, probably not something most companies are doing. But as we saw from the Enron scandal and others, many companies can take advantage of basically legal accounting practices in order to totally dupe and defraud investors. So it pays to be very, very skeptical about any financial statements a company puts out. That's it for me today. Happy saving.